Today I'm going to go over how I like to help people pick the right policy. So what we've got is a couple in their early 50s. We're specifically going to be looking at a policy for the wife in this example. She is interested in a whole life insurance policy specifically for infinite banking. She's interested in really maximizing the cash value up front and then being able to use this policy for purchases for the family. Now, what she's interested in is funding the policy with $50,000 per year until she's about 60 years old. She's 53 right now, so that's about 7 years. We'll go through the illustrations. She'd also like to see what it looks like if she starts out with $100,000 total in the first year. So $50K per year with an additional $50K in year one. Now, we talked a lot about a flexible policy. What does that mean? What does a flexible policy look like? Well, let's explain it, shall we? So if her target amount is $50,000 per year, does that mean she has to pay $50,000 per year? No, it does not. So with a life insurance policy, we have three main areas where our money can go. Really two, the base premium and the PUA rider, but the term rider is important. So if she wants to fund $50K per year, money can go toward the base premium first. We typically like to set this as low as we can. The reason why is because base premium dollars do not show up in cash value in the first year. The cost of the life insurance is heaviest up front. So we often set this as low as we can. What you'll see with the companies we're looking at, we can set it at about 10% of the total payment. So if 50K is my payment, or the maximum payment I want to make, then 10% of that would be $5,000. Then we'll add a term insurance rider. This might be $500, it'll be small. The purpose of this is to raise the death benefit. Now she says, I don't care about the death benefit. Why we raise the death benefit though, is because that prevents what is called a modified endowment contract or a MEC from occurring. That's why we do that. It keeps it tax-free, provided we follow IRS rules. And then the last item, the PUA rider, which stands for paid up additions. That's how we maximize the cash value. This would be what, 44.5 in this particular example. We put as much money as we can here in order to maximize the cash value, as this is what beefs up the cash value immediately. Now, speaking about the flexibility, because she would prefer not to get a bill for 50 grand every year, depending on the company that she goes with, I'll touch on that in a moment, she can set it up where she's only billed for this. So call it about $5,500 per year. So literally, she pays this one time per year. That can even be broken up over 12 months if she wants. And then this can be added at leisure, which means I go on my online account, I send a wire transfer. It's very, very flexible. And that type of flexibility is available with Guardian. So Guardian is very flexible when it comes to their PUA rider, where we can do exactly what I just mentioned. MassMutual, on the other hand, does offer nice PUA flexibility. It's not as convenient as Guardian. Big thing with MassMutual is that their PUA rider, if I'm making it very flexible and specifically using their LISR, Life Insurance Supplement rider, I can adjust this up and down, so I can vary how much I pay in PUAs every year, but just one time per year on my policy anniversary date, which is a fancy word for my premium due date. So that requires a little bit more discipline. MassMutual, on the other hand, while it's a little bit more stringent than Guardian, works really, really well for someone who says, I want to be able to feed this policy for a long time, not just 7 years, but 17 years or 27 years, a long time. Whereas Guardian's sweet spot is if I like that PUA flexibility, but maybe I want to stop the funding after 10 years or something like that, or pay just the minimum premium. But with all of that said, let's get back to her comparison. What we're going to look at is exactly what we see here. We'll see $50K per year until she's 60, but the first year you will see $100,000 going in. Now, the minimum premium with MassMutual can be 10% of the first year payment or deposit. If the first year deposit is $100,000, because it will be. She wanted to start with 100 in the first year. That means 10% is $10,000. Make sense? Cool. There we go. And then with Guardian, it'll be similar with one exception. That 10% is technically of the second year deposit, because Guardian's rule is that in the first year, we can go up to 50 times the minimum premium. In PUAs, that is, which means I can set that minimum premium then at $5,000, because beginning the second year, I'm funding $50K per year. Does that make sense? Point is, because they allow a large lump sum in the first year, I can still keep my minimum commitment very, very low, which makes it very flexible. Mass Mutual still is low relative to the $50K per year she's looking to pay in, but it is higher. All right, so we've got the illustrations, which I'm just gonna zip through here and then look at the comparison on Excel. So here's our Mass Mutual policy. You'll see the base premium up top. Here's our Guardian illustration. This is their 5% PUA fee. The STP represents short-term performance, which is their version of saying, here's our 5% PUA fee. And then if you don't see STP there, that means it is their 10% PUA fee, which is designed more so for long-term performance. All right, let's take a look at everything on Excel. So what we have first is the Mass Mutual 10-pay product. With this option, what she would be committed to is the 10K base. The true minimum out of pocket would be closer to $11,000 to $12,000 per year, when we include the cost of the term insurance rider. But it's about 10. She's got her PUA rider as well. Add the two together, you've got $100,000. First year cash value is rich. About 90% of what she paid in shows up in cash value, which is nice. Now, she funds $50K per year thereafter. She can go up to $100K per year with this example. That's a nice feature about this particular one. The break-even point is so close to year 4. She's paid in $250. She has $249 and change. Personally, I think she's going to get Ultra Preferred. This is not run at Ultra Preferred. It's the second best health class. If she gets Ultra, it's going to be positive by year 4, which will be sweet. But here we see it breaking even just about year 4 and then positive by year 5. And then once she hits 60, for now, she wants to stop. She does have the option to continue if she chooses to do so. Policy won't MEC because the MEC limit's $100K to handle that first year deposit of $100,000. So there's our 10-pay. Let's look at the two Guardian examples. So we usually like to show both of these Guardian examples. One gives more cash value up front, the other gives more long term. If you see the 5%, we're going to have more up front. It's a lower PUA fee, which means less of my PUA payment goes out the door to fees and it shows up in cash value. Long term, however, you'll notice it is not quite as attractive. What's very nice about this, the break-even point, so close to year 3 when we look at this guy. That's attractive. A lot of business owners, a lot of real estate investors like this product for that reason, where they just minimize the upfront hit on their personal or business balance sheet, and they also view it as an opportunity cost. They can put that money to work sooner, and they like the idea of flowing it through a policy. This option also has very, very attractive guaranteed cash values compared to the same product, but with a 10% PUA fee. Exact same product, the 10% represents the PUA fee. You'll notice the difference, particularly upfront, 87 instead of call it 92. By the 7th year, they're close, but you've got about 10 grand more in the 5% PUA fee. It's usually right around year 11 when they become equal with each other. So here's year 11. Look at that. Very close to each other. And then from the 12th year onward, you'll see the 10% PUA fee have much, much more, but that's solely based on the non-guaranteed values. The guaranteed values would tell a different story. You'd see more from start to finish with the 5% PUA fee option. So we've got the different illustrations here. Long-term, the Mass Mutual 10 pay is going to show the best looking numbers. However, I've seen Mass and Guardian always produce stellar results, both cash value and death benefit performance to their policyholders. I have a hard time saying one company is just better than the other or going to out-deliver. Like, no, I've seen them both deliver very attractive results to their policyholders. How I would probably refine my decision-making process here, or how I'd help someone, is I would start out with the flexibility. I would say, okay, when we look at these different options, Mass Mutual does have a higher minimum premium of $10K compared to Guardian at $5K. Are you comfortable with that, with the minimum being at 10? Probably closer to 11,000 and change with the term insurance rider. Ask that question. If she says, yeah, that doesn't really bother me at all because my target here is 50K. Okay, great. Next question I have for you is the 50K per year. Do you think you'd want the option to adjust that as the years pass? If she says yes, I'd say, okay, great. Mass Mutual will allow you to adjust this, but one time per year on your premium due date, which is a fancy word for your anniversary date. Are you okay with that, being able to adjust it just one time per year? If she says, yeah, I am. Okay, great. Next, I would ask about the loans. Mass Mutual, with this setup, offers a variable loan interest rate. I'd explain the variable loan rate and ask if she's comfortable with that. I just want to hit on the main check marks in terms of items that people are interested in, and then progress on. On to Guardian, the 5% versus the 10%. The guaranteed values, these aren't the guaranteed values, but I would go over those and ask, do you value the guaranteed values more so than the non-guaranteed values? Usually I get a follow-up question, do they perform better than the guarantees? The answer is yes. We track the actual performance. I've seen them perform very, very close to the non-guaranteed values, in many cases spot on. But with that said, I would still ask, the second question I would have is, do you like the idea of having more cash value up front? Meaning, do you intend to use this or just have access to it sooner than later when you compare it with this guy? Meaning you want access to that money up front? If someone says yes, I'd probably lean toward this. If someone says, yeah, but I'm not going to use all of it, like I still have plenty over here, more than I know than what I'm going to need, okay, the 10% could be a good option to choose. Next, the minimum premium. It's actually about 7K with the term insurance riders we have attached, but with that minimum of 5 to 7 with Guardian, do you like the idea of being able to commit to the minimum and just add more PUAs to the policy at your discretion, as opposed to the one time per year? If somebody says that, or even implies, yeah, I just think I'm really going to enjoy that over the years, that's where I usually say a lot of people who have expressed what you just did do tend to prefer Guardian, because as the years pass, if their cash flow is all over the place, this causes less stress. So I will say that. With that said, if you're starting with 100 grand and you've got more than that just cash on hand at the bank, Mass Mutual will probably work fine. My job is really to educate you on the different options and then work with you forever as long as you have the policy, which is what we do with all of our clients. But those are some questions, not all, but some questions that I would progress through with a client. Guardian, by the way, has a fixed loan rate at 5%, which is discounted to 4.76% if you pay the interest when it is due annually only. So that's another feature. But just as we're going through the different options, those are some questions I would ask. So which option do you think she chose? She has not decided yet. We're meeting later this week from our initial call. She did like that flexibility with Guardian, but I will say that everyone is different. We use both companies heavily. I hope you enjoyed this video. Please let me know if you did. Feel free to leave a comment below. You can DM me if you'd like to connect. LinkedIn is a platform I always enjoy. You can also check out our website, as we've got a ton of free courses and PDFs if you'd like guides to see what other people are doing and see the different ways that you could use policies. We've got a lot of material there. And as always, I hope this helps. Thanks so much.